Hey everybody, this is Tom Nash, and I'm a happy camper today because for me, there's nothing better than to open the week on a Monday with a 61-page warning about the end of the society as we know it by the head of the largest bank in the United States. I wish this was clickbait, I wish this was fake, but it ain't. Unfortunately, Jamie Dimon, someone's gonna make a clip out of this. Jamie Dimon got out of his bed Monday morning and chose violence. The man put out a 61-page letter literally warning us about every possible thing that can go wrong. He's talking about higher inflation, he's talking about higher interest rates, and he's talking about stagflation. Now, I'm not going to bore you with this 61-page letter. We're not going to go and read it together because that would be a waste of your time. My job here is not to be your friend. My job here is not to be nice. My job is to make your life simpler and help you make money. So I'm going to take this 61-page letter, which I've spent countless minutes of my life reading, and I'm going to give you the bottom line here because I think that's the best value I can provide in this environment. And most importantly, I'll give you actionable strategies, how to mitigate risk, how to prepare your portfolio for the things he's saying. Basically, how to set up for the possibility of a really, really bad event without absolutely missing out on a crazy bull market that we have right now. Now, let's talk about it further. What Jamie Dimon is talking about when he says higher interest rates, higher inflation for longer, and a stagflation environment, he actually puts a number on this, saying that I see up to 8% interest, not the current 5.25 we have, all the way up to 8% potentially. Now, he also says it might come down to 2%, so basically gave you a range of 2% to 8%, which is like saying, hey, I'm going to be over there to fix your fridge sometimes between Sunday and Tuesday. I mean, it's a little bit of a wide gap, but nevertheless, he is bearish. Now, he's talking about massive government spending, which would be a catalyst for this. He ain't lying, we know that. And he's talking about massive geopolitical mess going on around the world. Middle East, Ukraine, and many, many others. He ain't lying about that. So his underlying logic of why things are about to hit the fan, or the shit is going to hit the fan, so to speak, is basically kind of valid. I mean, he's not lying. Now, he is talking about a stagflationary period for the United States, and if you have any sort of a history in you, you understand that's a bad word. We never want to hear stagflation. That's like saying Voldemort. Nobody wants to say stagflation. Stagflation essentially means higher inflation, high unemployment, basically not a fun time for anybody. Now, what he basically saying is that investors should prepare for turbulence because things are not going to be as good as advertised. Obviously, we are in an election year. Everybody's trying to push the narrative that the plane has landed, the soft landing is here, and everybody can just relax. Now, he's basically saying, look, I'm going to be honest with you, I don't see it. I don't see it. In fact, I see a high probability of the plane crashing. Now, what he's saying here is very interesting. Check this out. He's saying, look, right now, stocks are being priced in on 3 assumptions. It's basically been priced in on an 80% or higher probability of a soft landing, 3 interest rate cuts in 2024, and 5 interest rate cuts in 2025. If that doesn't happen, if we don't get a soft landing and 8 rate cuts in the next 2 years, the correction is going to be extremely violent. If the Fed has to pivot back from quantitative easing into quantitative tightening because the circumstances will change, he's definitely on point. The markets will react very, very negatively. Now, the second point he's making here is twofold. He's saying, look, geopolitically, we are dealing here with a cluster freak of epic proportions. On the one hand, because of all this geopolitical mess in Ukraine, in the Red Sea, we have massive supply chain issues nobody's talking about. That is highly inflationary. When ships can't travel through the Suez Canal, that's going to put prices up. On point. He's also saying, on top of it, we have oil prices cyclicality, which tend to go up in the summer months, which nobody accounted for. Right now, the market is completely ignoring the fact that we're headed straight into $90 barrel territory. And that, of course, will also be inflationary. Basically, what he's saying is that, look, there's a lot of negative catalysts that are creeping up that nobody's talking about, and you should pay attention to. And actually, just a couple days ago, Jerome Powell literally said, hey, we're not in a hurry to drop rates. Nope. The economy is fine. We have plenty of time. We're not going to drop rates because you want us to. We're only going to do this when we're sure it's absolutely the right time, and we may stay higher for longer. His words, not mine. So in that case, Jamie Dimon might not be completely off. Now, before you go selling your portfolio, wait. I have to give you a little caveat here. Now, Jamie Dimon definitely has skills. He has the information, the resources, the access, the experience, all that. But Jamie Dimon has been in the more bearish camp for a while. He's generally more bearish about the market, at least for the past few years. And when he says things like this, it ain't a pivot. It's just basically what he's been saying for the past couple of years. In between, we had a crazy bull market. We had a lot of stuff that didn't exactly go based on his bearish stance. So you have to understand that not everything that Jamie Dimon says, with all due respect, is going to happen exactly like he predicts it. Now, I will actually add one little tidbit here, which actually completely changes this whole thing, and mainstream media is going to miss this. You have to realize that in this letter, he also said one important thing, that he is very bullish long-term about the market. He's basically saying, look, the invention of artificial intelligence is the equivalent of the invention of electricity. And that's going to catapult the market into new highs we have never even imagined before. So while he is very short-term because of inflationary pressures, long-term he is extremely bullish, which once again, for the millionth time, should prove to you that time in the market always beats timing the market. Now look, the question here is, given what Jamie Dimon just said right now, how do we prep for this? How do we make sure that we buy some insurance in case this dude is right? And honestly, half of the solution is just that, realizing that time in the market basically solves all wounds. And as long as you stay in the market, as long as you stay invested in good US companies in the US economy, you'll be fine. But there's still about 50% of it that we have to talk about here in this video. The other 50% have to do with doing preventative maintenance to your portfolio. Number one, if you are up massively on a few stocks that ran up in 2023, if you've made a lot of money in 2023, you can take a third out and put in cash. Why? Well, in case the market goes absolutely ballistic and the next bull run is even crazier than everybody thought, then still 2/3 of your money is in play and you're making great returns. But if Jamie Dimon is right, and if we're actually headed to bad times, at least you saved 1/3 of your portfolio and cushioned the fall a little bit. You actually get to enjoy both scenarios. Now, obviously, it's a personal choice, not telling you to do or not do that. I'm just showing you one option of how to handle this. Another option is setting up stop losses. If you have stocks in which you have massive gains, but you don't want to liquidate just now, you can set some stop losses in case the market goes haywire. So in case the market actually goes haywire, you don't get caught in and actually lose a lot of your gains and basically have to liquidate at much lower prices. Now, another thing you can do right here is basically focus on stuff like bonds, on stuff like dividends, and on stuff like money market funds. And while a lot of you have never invested in bonds, guess what? Vanguard actually did a study. They looked at the top 1% of investors, and they have an average of 23% of their portfolio allocated to bonds. So the top 1% have almost a quarter of their portfolio in bonds. Guess what? You don't want to invest like the rich? You don't want to invest like the top 1%? Now, obviously, mitigating risk is important, but another thing you can do if you have a little bit more risk tolerance is actually use this to your advantage. What do I mean? Well, look, at the end of the day, what you want to be doing is you want to buy things on the cheap, right? If you want to buy a car, you want to buy it late in December when the salespeople are all before the bonuses. You'll get a better discount, right? A ski vacation in the summer, you get the point. So if you can find a company that has a great business but is underperforming on the stock price because of higher interest rates, that's the sort of businesses you want to invest in a bad environment. If Jamie Dimon is right, if 2024 is going to have high interest rates, then companies that still have a great business will not see a great stock performance. They're going to actually get beaten down. Those are the stocks you can pick up on a discount if that's indeed the case. Now, we did mention one stock like this. We did a full deep dive analysis on our Patreon weekly Zoom call over on Patreon, patreon.com/Tom Nash. More than welcome to join. You can actually check it out and actually see if that's for you. In today's video, right here, I want to show you another stock I'm thinking about, which has a very similar setup. Now, over the past 3 years, this stock ran up its revenues by 150%. Same period, free cash flow is up 160%, net income is up 120%. However, over the past 12 months, the stock is down 15%. Now, I'm talking about a REIT, a real estate investment trust. Now, for those of you who are not familiar with the structure, it's very, very simple. Think about it like a holding company, like Berkshire Hathaway, But instead of holding stocks in other companies, what they hold is real estate. They can hold apartments, warehouses, commercial real estate, land, and basically they collect the rent from this land they own, from the real estate they own, and every time they collect the rent, they pay it out as a dividend to their shareholders. Now, the best thing about a REIT is that it actually allows small investors like myself, like you, to actually invest in large real estate projects. You don't have to put up millions, you can put out whatever you can, and you get a little piece of that project. And here's the thing with the REIT, it's a real estate investment trust. So the share price is going to be dominated by the state of the real estate in the United States. So when interest rates are high, like they are right now, people are saying, well, at this loan, I don't want to buy this house. I'm going to wait until the Fed drops rates. So I'm not going to be buying. So in that case, demand drops, prices go down, and then sellers, they don't want to sell. They're going to say to themselves, well, we're going to wait until interest rates drop and prices climb up a little bit because we don't want to sell this price. Nobody's selling, nobody's buying. And that's exactly what happened in 2023. That's why real estate trusts, REITs, have been beaten down and underperformed the S&P 500. Now, here's the thing. Over the past 30 days, the stock is climbing a little bit. Even though it's dropping 15% of the past year, over the past month, it's up 6%. Investors are slowly starting to climb back on board, thinking that we're going to have 3 rate cuts in 2024 and 5 next year. Overall, 8 cuts over the next 2 years, giving us a 3% interest rate, which is way more hospitable for the real estate market, and it will have a positive impact on this stock. If the stock continues to drop because of what Jamie Dimon said, if the market isn't really ready yet for interest rate cuts, and we're going to have more QT, more quantitative tightening over the 2024 period, then the stock will keep dropping and you can pick it up slowly over DCA. And when it bounces up in 2025 or 2026, your cost basis is going to be up in the bottom. Whatever the case may be, as long as you have patience, you'll be fine. All while buying this massive real estate trust, one of the best in the business, a category leader, $50 billion market cap. Yes, it might take another beating if rates remain high, but at the end of the day, this is a dividend monster. Whether the stock price moves up or down, you're still going to get that dividend no matter what. And when the interest rates drop, whether it's 2024, 2025, 2026, as long as you have that patience, you will be fine. Now, as always, I want to thank you if you lasted this long in the video. If you have, I invite you to join our Discord. We're almost at 10,000 members, discord.gg/Tom Nash. We would love for you to join our community. It is absolutely free to join and participate. And if you want to upgrade and actually take a step forward and join the Academy, we actually launched a new gold members tier right now, absolutely brand new. Join, check it out. We'll teach you how to do a DCF, how to read financials, how to get better as a long-term investor, how to learn the skills, not to feed you stock picks, even though I do that once in a while, but I want you to do it for yourself. So patreon.com/Tom Nash, join the Academy. And if you haven't yet, get Stock MVP right now. 1 week, try it out for free. And then, if you're happy with it, use code TOM25 for 25% off for your lifetime of use. Stock-MVP.com. It's a software we built as retail investors for you guys, the retail investors. You can run your DCFs, you can look at stocks, MVP cards, you can compare stocks, a lot of different features we built for you as a daily driver for your stock research. Thank you so much. I'll see you in the next one.